Welcome back. This is the gold market review for the 11th of January. Gold finished the previous week in red territory, but seems to have regained its confidence in the most recent daily sessions and managed to climb higher, with the trend picking up until today in the early European morning. Gold has been driven by important economic indicators released in January, the US dollar, and other key fundamentals that are fueling the market currently. In this report, we will attempt to identify these key subjects, keeping also in mind the economic calendar that unfolds in the following days. In the end, we will also provide our technical analysis, identifying important levels that traders can work with. Enjoy the report. As noted in our intro, gold's downward trend in the past week may have been interrupted after the US employment report seemed to have enacted a buying demand for the precious metal. The US employment report indicated that the unemployment rate fell from 4.2% to 3.9%, while the non-farm payrolls figure came out at 199,000, which was lower than both previous and expected figures. The US dollar moved lower after the release of the figures, which may have disappointed traders and subsequently benefited gold's price. The upward momentum enacted after the release of the report on Friday persists to this moment, while today the market awaits Fed Chairman Powell's testimony before the Senate's Banking Committee for his reappointment. Comments on the Fed's future steps with monetary policy, employment, and especially inflation are expected to keep traders busy. Another event that may be preparing the path for a change in circumstances and possibly the price action in the gold market was the confirmation of a reduction in the Fed's balance sheet. In the past week's release of the Fed meeting minutes for its mid-December meeting, the Fed confirmed it will be trimming down its purchases for Treasury and agency mortgage-backed securities. This move can push bond yields higher, as it could be signaling the Fed is currently satisfied with the performance of the economy despite still operating under the pandemic spell. Rising bond yields are usually a sign that gold may lose value, yet this has not been the story in the past days. The US 10-year Treasury yield rose while gold remained elevated in the current week. This may be evidence that the market could be in a positive position to enjoy an improved environment, while on the contrary, cutting down on the Fed's asset purchasing program may be creating some worries at the moment, as businesses may not feel so confident as the new variant continues to reel on a global scale. The news may attract safe haven inflows for gold's price, as it can be used as a form of hedging for times of uncertainty. As traders turn their focus to the economic calendar in the coming days, a handful of very interesting and decisive indicators will be released. We highlight the US CPI rates for December that will be released on the 12th of January in the early US session. CPI rates have almost always been a source of energy and create volatility for the gold market. Thus, we suggest traders to be mindful of opportunities and risks that may arise. On the 13th, we get the weekly initial jobless claims figure, while on the 14th, we get the very important US retail sales figures and the industrial production rates, both for December. Finally, also on the 14th, we get the preliminary University of Michigan economic sentiment figure for January. Moving now to our technical analysis, please note this is gold's 4-hour chart. We are leaving our levels unchanged since last week's report, as the market has returned within the range between the R1 1815 resistance and the S1 1795 support level. During the past week, gold ascended to reach and test the R2 1830 level and subsequently returned lower to test the S2 1785 level. Please note the R2 1830 resistance is the highest level reached since late November, and the S2 1785 support line has not been breached downwards since mid-December. The R1, R2, the S1 and the S2 levels have been tested in January, making them very relevant to traders. We also leave open the scenario for a considerable move upwards that can bring into focus the R3 1850 level, while a strong bearish trend can send gold to the S3 1765 level. The RSI indicator below our chart continues to move nearby the 50 level, confirming the market may be waiting for the specific information prior to taking action. At the moment, we could say gold is moving in a sideways motion between the R2 and S2 lines. If any one of these levels is breached clearly, upwards or downwards accordingly, then we would suggest a change of trend. Thank you very much for your time and your focus. We appreciate your participation. And if you like this video, please feel free to share and subscribe. From everyone here at IronFX, wishes for solid trading.